All right, we're good, Christina. All right, technical difficulties are over.
Okay. Now, pay attention now. This is the bottom line, okay? I raised myself so I could see all of you. Are you still awake? Yes. Okay. All right. So, let's say, all right, let's say you own a property. I said earlier, you're very conservative. You only own one home, trying to pay it off. So, here we go. So, let's say you own, property A. Can you see it? I'm high tech. Okay, so let's say you have a loan balance of $200,000 a month. $200,000, your loan balance. So, let's say you're trying to pay it off early, so you took a 15-year loan to pay at 6% interest rate. So the monthly payment on that is $1,688 a month. Are you listening? Yes. Okay. So let's say the value is $700,000. All right? So, right there and then, there's an equity buildup of $500,000. That's right. You know, when I see this, whenever I see this, I see a sleeping giant. All right? So here's what I'm going to do. I'll do what I call an option 1. Now, this is good, but it's not the best. Okay? Option 1. What is option 1? Okay? Refinance. Take some cash out, because I want to let this sleeping giant work for you. I'll take some cash out and then buy. What do I need to buy? I'll put it into 2 properties right away. Okay? What are these? I'll put it into what I call a short-term investment, which is normally a single-family residence. And the other one, I'll put it into a long-term investment, which is at least 4-unit apartment complex. Because in order for you to become a complete investor, you have to have both a short-term, okay, and a long-term. The short-term, okay, does not create an income. If you put a 20% down, all right, this will give you no cash flow. All right, it just pays by itself. But it goes up in value faster. That's why it's called short-term. On the other hand, the long-term investment, okay, if you put at least 30% down payment, this will give you a cash flow at today's market of at least $1,000 a month. This is after subtracting the principal and interest, taxes, insurance, utilities, and management. I don't want you to manage. We have a property management company because I don't want you I want it as if the property for you does not exist. Okay? So, in this case, all right, now, what will happen to your mortgage payment then? All right? Okay? What will happen to your mortgage payment? Okay? Now, so, the bank, if you are husband and wife, both have jobs, have good credit, all right, they will give you an 80% loan to value. What is 80% loan to value? $560,000. All right? Now, with $560,000, are you listening? Okay. Now, because you have a loan balance of $200,000, they will pay that thing off. All right? So they'll pay it off, $200,000. So the cash flow, the cash out is $360,000. This is your cash out. Now, what I'll do with this cash out, I'll put the 20% down to this short-term investment, and then the other amount of money I'll put in here on the long-term investment, and then I will put a reserve, okay? Reserves of at least $30,000 for rainy days, all right? So what will happen now to your new mortgage payment? Your new loan balance, okay, is $560. Now, believe it or not, even though the interest rates has gone up, we still can get a low interest rates of 40 years, okay, 1.75% interest rate, once a year adjustment. So the mortgage payment in here is $1,623 a month. Okay? Are you still with me? Yes. Okay, $1,623 a month. Now, but because you have a cash flow of $1,000, that's your income, we will subtract it in here on your new mortgage payment. So what will happen is your out-of-pocket expense is only $623. Did you get it? Okay, so which one would you rather have? Okay, have one house that pays $1,688 a month, which comes out of your pocket, or have 3 properties that goes up in values and only pay $623 a month. Which one would you rather have? Of course. Now let's go to the income producing. Now, these properties earn 3 ways. One way it earns is through cash flow. Goes to you every month. Number 2, appreciation. Do you know that even last year, the rental market's still down, but the apartment complexes did not go down in price. We still made here in Silicon Valley at least $100,000 in equity buildup in 1 year. So that's good. It's not bad. Now, so another thing is tax shelter. Okay? You know, the money that they withhold from you, every paycheck, most of that, if not all, comes back to you because you have an investment. You see, after a while, you can now refinance this, get some cash out, and buy again. The goal is to have as many as you can properties. Before 9/11, we were averaging $2,500 a month cash flow. Okay? Now, I have good news. It's coming up. Because here's what's happening. When the interest rates go up, listen to this, normally the rental market goes up. And so as the values goes up, okay? Now, here's good news. I have a report here. You can look in the internet. Yesterday, there was a report of the top markets that has the most rent increase. And guess what it is? San Jose, California had increased by 12%. Look at it in the internet. This is a all over the country report. Now, here's the other good news. Okay? The occupancy rate, okay, is number 1, San Jose, California, with 98.2% occupancy. That's good, okay? And the second one is New York, and then San Francisco, and Los Angeles. But San Jose is number 1 in the occupancy percentage, and that's good. Now, so mark it down. This 2,500 is coming up, all right? Now, just imagine if you have at least 4 of this. And some of you, I have done at least in one sitting 2 to 3 properties in one sitting, okay? I was able to produce 3 fourplexes for them. Just imagine if you have 4 of this in the next couple of years. And it creates an income of $2,500 a month times 4, okay? Can you still see? This will give you a cash flow of $10,000 a month. Now, if you have this kind of cash flow, do you still need your 8 hours job? If you want to work work as a hobby. Another thing, okay, if you have this kind and you are able to also produce more of this short-term investment, okay, if you want to pay off your house, pay it off. But you did not pay it off by yourself. You let your investment properties pay it off. All you have to do is get equities on each one of them and pay off your house. However, I'm not going to advise you to do that because Uncle Sam will hit you with taxes. Instead, what I would like you to do is move into the investments of all the investments, which is commercial properties. Okay? Now, commercial properties has a lot of cash flows. Okay? Now, with this one, but you need a lot of money to get into this part. So that's why I do it phase by phase, stage by stage, until you hit on this stage. Now, most of these commercial properties, okay, has what we call a triple net leases. What does it mean? Okay, triple net leases means all the property tax, insurance, maintenance, and management are all paid by tenants. Okay? They're all paid by tenants. And the owner's responsibility, okay, is only the debt service, which is the principal and interest. Isn't it nice? No more hassle with the tenants. All right? But, all right, in here, the properties of this, okay, creates a lot of income. And so, with this, now, how many of you, I had the opportunity of helping buy a commercial, let's say during the last seminar or last year, you are in escrow or you've owned a commercial property already? Raise your hand. Okay, few of you. All right, good. About probably 12, 15 of you. That's good. Okay? Now, how many of you have been to my office before? Raise your hand. All right. You know, God blessed me with that complex. And guess what my cash flow is? You want to know? You want to know? $43,000 a month. But you know what? That's hard to spend. It's true. That's a lot of Giorgio Armani suits. Okay? Now, let me show you, okay, some examples of a commercial property. Okay? Let me show you some example. Are we ready? Okay, this one. All right? This one I've sold in I believe this is in Texas, all right, to one of my clients last year. It has a national brand tenants like Quiznos and H&R Block, and it gives them a lot of income. Now, let's see another one. Okay, how about this one? All right, I think everybody recognizes Walmart, right? Now, listen to this. But let's say you don't have enough capital to invest in a higher-end commercial property like this. Then what? This is where my new program can come in. I call it FIT, F-I-T. What if you could leverage the power of multiple investors to get a partial share in this higher-end commercial property? Do you like it? Yes. And that is what my new FIT program is all about. FIT means fractional interest transfers. And that's my brand, okay? And this program will let me open new doors of opportunity for my clients. You know, just imagine, instead of investor number 2, my FIT program makes it investor number You. See? Just imagine that. You'll have an opportunity to own a part of a national brand commercial complex. Now, let me say this. I am not just talking about a TIC program or TIC program. Tenants in Common. How many are familiar with that program? Okay? This is not the TIC program. My unique program gives my investor, number one, a monthly triple net cash flow. Okay? Number two, they have the ability to buy properties above their financial means. Okay? Number three, all right, can you see it? Now, they have actual ownership of a percentage of the property. You have actual percentage of the property. You own it. Number four, participation in real equity growth, not just a flat percentage. Where TIC program is, you know, whatever in TIC program, if the appreciation goes up so high, you don't get it. The management get it. Okay, in here, you get everything. Okay? Number five, fully compliant with 1031 tax deferred exchange. You can exchange your property, you know, smaller properties to get into this. You like it? Yes. Now, I will be launching this program with a small group of my clientele by invitation only next month. So it's here, September. It's right around the corner. So it's time for all of us to get fit. Huh? Yes. Now, do you believe that's just option one? Okay, let's move to option two. What's option two? Okay. Option two is the best because this will escalate you faster to commercial. What's option two? Option two is still property A, sell property A, and move to property B, which is normally a semi-custom built or custom built home, because these properties goes up in values faster and higher than a truck home. Okay? Then the rest of the money, okay, don't put all your eggs in one basket. You can put it into income producing properties, and sometimes I could put it into two right away. So the cash flow here, let's say $1,000 a month, $1,000 a month, okay, $2,000 will help you pay for this. And it will give you an opportunity to move to the next level or to move to the commercial faster. That's why I like it. Okay? Now, let's go to option three. Are you still there?